Hey everyone, let us talk about something big, something that honestly will affect all of us. Whether we realize it or not, we really need to pay attention to what is happening. There is this feeling, this growing concern that Japan's financial system is under immense pressure, and if it collapses, it could really bring down a lot with it. This is a huge deal, folks. I know some of you might be thinking, Japan, Japanese bonds, why should I care about that? I live in Florida or Ohio or Texas. I am trying to pay for my mortgage, buy groceries right now, fill up my gas tank, and maybe keep my retirement account from getting wiped out. I totally get it. But that is precisely why this matters so much, because Japan isn't just some faraway island economy that has nothing to do with your life. Japan is one of the foundational load-bearing walls of the entire global financial system. And when a critical load-bearing wall suddenly starts cracking, the whole house starts shaking. So let me try to explain what is exactly happening here. In simple terms, for decades, Japan has been conducting one of the biggest financial experiments in modern history. This involved massive government debt, artificially low interest rates, intense central bank intervention, something called yield curve control, and printing money, much like our own Federal Reserve does. The Bank of Japan essentially told the market, hey, don't worry, money will be cheap forever. Okay, but here's the fundamental problem with that. Money is never cheap forever. Eventually, reality shows up and it tends to hit you hard. It is a bit like drinking alcohol every single day and then pretending you are not an alcoholic. People like that can only deny it for so long before the truth becomes undeniable. And right now, reality is making its presence felt in the Japanese bond market. Now, please don't let your eyes glaze over. Let me make this clear and easy to understand. Long-term Japanese bond yields have been surging, meaning the cost of borrowing for the Japanese government is going up significantly. The 30-year Japanese government bond has been hitting record levels, and the 10-year yield has been moving back toward levels Japan has not seen since the 1990s. This is not just a Japan-specific story, and this is where it really becomes crucial for us in the United States of America. 2 years ago, I was talking about this, warning all of you that Japan is one of the largest foreign holders of U.S. treasuries. Japanese banks, pension funds, insurance companies, and various institutions are deeply tied to U.S. bonds, to European bonds, and the global market in general. So, when Japan starts taking significant losses at home, what do they typically do? They sell whatever assets they can. They start dumping us treasuries like a bad habit they need to get rid of. That means U.S. treasuries get sold off. That means global equities come under pressure. That means pressure on the very markets that are currently holding up your 401k, your pension, that are affecting your mortgage rate, your credit card rate, and your car loan. This is essentially the plumbing of the entire global economy right now, and the pipes are showing serious cracks. So take a look at this on your screen. If you can visualize it, this is the U.S. 10-year Treasury yield going back decades. And every time these yields spike significantly, something in the financial system eventually breaks every single time. I mean, think about it. Look at the 1987 stock market crash, the 1990 recession, the Mexican peso crisis, the Asian financial crisis, the tech bubble burst, the global financial crisis, the euro debt crisis, the taper tantrum, and the 2018 global sell-off. Over and over again, the bond market starts signaling trouble, screaming loudly long before the stock market acknowledges that there is a major underlying problem. But here's what is fundamentally different right now compared to those past events. For 40 years, we were essentially in a bond bull market. Interest rates kept consistently falling. Every crisis, every economic hiccup could often be papered over with even cheaper money. The Federal Reserve could just continue to cut rates. Governments could just borrow more and more money. Wall Street institutions could easily refinance their debts. Consumers could borrow more money at low rates. Corporations could roll over their debt without much issue. That was the established system, the way things worked for decades. But now, that 40-year trend looks like it is decisively over rates, crashed to zero during the COVID pandemic, and then they reversed direction violently, moving much higher. Now we are back near 5% on the 10-year Treasury. The 30-year Treasury is hitting levels we haven't seen since before the last major financial crisis. This is not just a normal market cycle we are experiencing. This is, in my view, the clear end of an entire economic era. And look at household wealth. Consider this second chart, if you can imagine it. On paper, Americans have never looked richer than they do right now. Real estate values exploded, stock prices exploded, retirement accounts swelled, housing values increased dramatically. Mutual funds and corporate equities have gone up almost vertically since 2020, but here is the uncomfortable truth behind those numbers. A significant portion of this is just paper wealth. It looks fantastic on a spreadsheet, it looks great on Zillow when you check your property value, it looks excellent inside of your brokerage account when the SP is near record highs, but can you actually use that wealth in a practical, tangible way? I always say you cannot eat equity. You cannot feed your family with equity in your home or your stock portfolio. Your house may be worth a lot more on paper, but if you sell it, where are you going to go? Your current mortgage rate might be 3% right now, but a new mortgage would be 7% or even higher. So your 401k might appear very healthy, but it might be heavily riding on just a handful of mega cap tech stocks right now. Your home equity might look huge, but tapping into it means borrowing at much higher interest rates. So many Americans right now are paper wealthy, but they are actually cash poor. And that right there is the trap. The truly rich own productive assets. The middle class often owns liabilities that are dressed up and presented as assets. And the poor, unfortunately, are just getting utterly crushed by rising rents, surging food prices, increasing insurance costs, growing debt burdens, and escalating energy expenses. I was talking to our neighbors just yesterday, and one of them couldn't believe it. She filled up her truck and said it cost her $111. And she just stood there and laughed out loud, a sort of desperate laugh. And the woman next to her laughed too, saying, I know, all I guess I can do right now is just laugh. I don't know what else to do. I have no choice. So that is how this silent wealth transfer happens right now. Not all at once, not with a bang, but slowly, quietly, and then suddenly it becomes undeniably clear. Now, look at this consumer discretionary number, because this chart may be the scariest one of all. This shows us consumer discretionary stocks equal weighted compared to the SP 500. In plain English, this is showing us how the average company that directly serves consumers is performing compared with the broader market. And it is collapsing, guys. I don't want to sugarcoat this or pretend it is not happening. We are back near the levels seen during the Great Financial Crisis. This means that the businesses that depend on regular Americans having extra money to spend, like restaurants, retailers, travel companies, leisure industries, and those selling home goods and apparel are already telling us very clearly that the average consumer is tapped out. Costco just 2 weeks ago publicly stated that their customers are pulling back on buying red meat, a staple purchase. And every time their customers have pulled back on buying more expensive red meat in the past, it has signaled that the economy was facing a significant downturn or even collapse. But you wouldn't necessarily know that by just looking at the general headlines or the performance of the SP 500. This is because a tiny, concentrated group of massive technology companies is effectively masking the pain that is bubbling underneath the surface. That is the K-shaped economy that we hear so much about. The top keeps floating higher and getting richer, while the bottom gets increasingly crushed. Wall Street celebrates record highs, and Main Street is bleeding. Credit card debt is at an all-time high. Buy now, pay later services are exploding in popularity. Car payments are outrageous for many. Insurance costs are through the roof, and grocery prices are still painfully high. People are simply borrowing money just to survive right now, just to make ends meet. And yet, the media often keeps telling you that the economy is strong. Strong for whom? For Nvidia, AMD, and the top chip manufacturers. Maybe for them it is strong because the average American is not experiencing strength. They are experiencing deep financial exhaustion. That is precisely why Japan matters so much, because Japan may very well be the fuse that ignites something larger. The bond market may be the match, but the explosion, if it comes, will land right here at home, affecting all of us. So, where does this money go? What happens next? Well, this is, in my opinion, the beginning of the greatest wealth transfer in a generation. Money is actively moving out of what I call paper promises and into real, tangible things right now. Things like energy resources, copper, silver, uranium, critical minerals, food production, productive land, essential infrastructure, warehouses, defense industries, and manufacturing. Anything that is real, anything that is directly tied to the physical world, is becoming more valuable. The old system for a long time was built on an abundance of cheap money. Cheap imports, cheap labor, cheap energy, and seemingly endless debt accumulation. And that system is clearly breaking down. This new system, which is rapidly emerging, is about reindustrialization, bringing manufacturing back home, rearming with massive trillion-dollar defense budgets, strengthening supply chains, modernizing power grids, and all of it. Data centers, rockets, satellites, nuclear energy, mining operations, manufacturing facilities, refining processes, all of it. This is why commodities matter so much in this new era, because you simply cannot build the future with fake financial engineering or speculative assets. You need actual physical things. You need copper, you need silver, you need uranium, you need oil, you need gas, and you need steel. And then, of course, on top of all of that, you need abundant electricity to power everything. And the people who understand this significant shift early on, who recognize these underlying trends, will be in a very different and much stronger financial position compared to the people who just keep pretending that this is merely another normal economic cycle right now. This is not normal. Japan is cracking under pressure. The bond market is yelling as loudly as it possibly can to warn us, and consumers are clearly breaking under the strain. I mean, you are seeing local restaurants closing, you are seeing businesses laying off tens of thousands of people. People just don't have the expendable income they once did. And the greatest wealth transfer in a generation is already well underway. This is all happening right now.